As the global economy navigates the turbulent waters of post-pandemic recovery, the debate over inflation's trajectory has taken center stage. In the United Kingdom, a contrarian voice has emerged, urging caution against the prevailing market sentiment that rate cuts are imminent. Greene, a hawkish member of the Bank of England's Monetary Policy Committee, MPC, has sounded the alarm, challenging the market's optimism and highlighting the unique challenges facing the British economy. In a scathing critique published in the Financial Times, Greene questioned the market's pricing, which suggests the Bank of England, BoE, would cut rates earlier and more aggressively than the Federal Reserve this year. She argues that investors are underestimating the risk of inflation persistence in the UK, which has faced the double whammy of a tight labour market and a far more significant energy price shock compared to other advanced economies. The markets are moving rate cut bets in the wrong direction, Greene wrote, her voice echoing through the halls of economic policymaking. In my view, rate cuts in the UK should still be a way off as well. Greene's dissenting view is not without precedent. Since joining the MPC last August, she has consistently taken a more hawkish stance than the majority of her colleagues on several occasions. Her recent comments align with those of Jonathan Haskell, another MPC hawk, who cautioned that interest rate cuts should be a long way off because a near-term fall in headline inflation would not be a reliable guide to persistent and underlying inflationary pressures. The crux of Greene's argument lies in the unique challenges facing the British economy. While UK consumer price inflation fell to 3.4% in February, its lowest level since 2021, the BoE's latest forecasts suggest this drop will be temporary, with domestic price pressures pushing headline CPI back above the central bank's 2% target for much of the next 2 to 3 years. Both Greene and Haskell argue that UK wage growth and services inflation remain too high for comfort, despite recent signs that pressures in the labour market are finally easing. Their concerns echo the fears of many economists who warn against prematurely loosening monetary policy in the face of deeply entrenched inflationary forces. However, not all policymakers at the BoE share Greene's contrarian view. Andrew Bailey, the central bank governor, told the Financial Times last month that rate cuts were in play at future MPC meetings and that the committee should not wait for annual growth in wages and services prices to have from the current pace before it was willing to ease policy. Hill, the BoE's chief economist, has also made it clear that policy would remain restrictive even with interest rates below their current level, meaning that the BoE would still be bearing down on inflation even after it had begun to ease policy. As the debate rages on, Greene's warnings serve as a sobering reminder of the complexities and uncertainties that policymakers must grapple with in the aftermath of the pandemic. The UK's unique economic challenges, coupled with the lingering effects of Brexit and the energy crisis, have created a perfect storm of inflationary pressures that defy easy solutions. In this uncharted territory, Greene's contrarian voice offers a crucial counterpoint to the prevailing market sentiment. Her skepticism towards premature rate cuts highlights the delicate balance that central banks must strike between supporting economic growth and maintaining price stability. While the allure of easing monetary policy may be tempting in the face of economic headwinds, Greene's cautionary tale underscores the need for vigilance and a data-driven approach to policymaking. Inflation, like a raging river, can be unpredictable and treacherous, requiring a steady hand at the helm to navigate the currents safely. As the world grapples with the aftermath of the pandemic, the contrarian voices like Greene's serve as vital counterweights to groupthink, challenging conventional wisdom and reminding us of the inherent uncertainties that pervade the realm of economic policymaking. In the end, the decision to cut rates or maintain a hawkish stance will be determined by a delicate dance between data, projections, and policymakers' willingness to embrace contrarian viewpoints. Greene's voice may be a dissenting one, but it represents the healthy discourse and intellectual rigor that must underpin the decision-making process in these unprecedented times. As the global economy charts its course through uncharted waters, the contrarian view offered by Greene and her fellow hawks may prove to be the navigational beacon that guides policymakers towards a safe harbor, where price stability and sustainable growth can coexist harmoniously.